All right, we got a special episode here, joined today by a good friend of Keith Dickers, as you guys are familiar with, Michael Nicoletos here. Michael used to run an emerging market hedge fund. He's now in the process of setting up a new fund, but big global macro guy, extremely smart, guy that's day to day in the trenches. So we wanted to connect with Michael and just kind of get his views on how he sees the world shaping up. So Michael, thanks so much for joining the show.
Thank you, Steve. Thank you for having me. Great to be here.
Yeah, so we're at a very interesting time in the world right now. Obviously, so you're over in Greece right now. Lots happening in the Eurozone. Obviously, the inflation surging, the ECB is in a very difficult predicament. I know they're talking about basically a dumbed down version of basic. I mean, they're not calling it QE, but saying, hey, listen, we're going to call it the anti-fragmentation tool, which is let's bail out Italy here. I'm kind of curious, how are you looking at this? How are you looking at the Eurozone? I mean, just global macro in general. Like, what are your thoughts in the current environment today?
Well, let me say something. The people tend to watch the world through the lens of the US and the US dollar, and it's pretty natural because the dollar is the dominant currency in the world right now. But currencies and economic areas are relative performance and not absolute. So when you look at a country and you're saying it's going to do well or it's going to do bad, it's not only the economy is going to deteriorate, it's also how it's going to perform versus the other countries. So Europe has the problems that everyone else has, and it has another problem, which is 19 countries with different economies, with different needs that need to be addressed at the same time. Now, the big problem for Europe right now is twofold. The first one is the energy crisis. And Europe imports most of 40% of its energy, so it's a big problem, and most of it comes from Russia. So, given what's been going on in Ukraine, there have been some issues in terms of supply, in terms of the energy prices and everything. So, Europe is getting that pressure on the supply side and on its cost side. But the problem is that because the US has been raising rates at such a speed, the euro has been falling versus the dollar. And as everyone knows, most commodities are priced in dollars. So the inflation pressure for Europe becomes even worse. So they need to find a way to elevate the value of the euro without destroying the European economy in terms of creating a recession or a crisis. And this is a very tough spot for Europe. So they've been discussing about raising rates. There have been a few issues, and Lagarde has been coming out and saying that we will raise rates. That's one side, and then suddenly the spreads of all the southern countries of Europe went through the roof, and Italy went at some point, I think, 4%. Now it's a bit lower because the ECB came out and said, we will figure out a way to cap yields. They didn't give any specifics, but they came out and said, we will figure out how to do that. Now this becomes a bit tricky. Why is that? Because there is a pre-allocation on how the ECB buys bonds. So if the ECB does not want to change the quantity of the QE, it means that we'll need to change the ratios of the bonds it's buying. So it would need to buy more of countries that it was buying up to a cap. That means that I find it very hard for Germany and the German constitution to approve that. You never know, they could approve it. But until now, Germany has been very tough and has always been, very skeptic about doing such things. So this is the reason also why the ECB has always been a bit late in acting. It's because 19 countries need to agree on something. So ECB, the European Union has the problem with the inflation coming from the energy crisis. It has a problem with the supply chains coming from China, like everyone else. And it has a framework where 19 countries need to agree upon something. So it's not very easy for Europe.
How do you see this personally playing out, though? Like, I mean, the ECB is still running negative interest rates. They're talking about getting to zero. Keith calls it the economic fantasy land. What's your personal opinion of how this plays out? And you said, like they said, Germany is likely not to approve, this anti-fragmentation policy.
But I think they'll get to zero. Negative rates have been a disaster, has not been a success. So going to zero, for me, is a no-brainer. Now, the thing is, how do you go to zero? And Italian bonds don't go to 4, 5, 6, I don't know where they can go. And where Greek bonds don't go at 7, 8%. or whatever they could go. Just a reminder, for example, Greece entered a crisis when their bonds went to 5.5% approximately in 2010, and now Greek debt to GDP is close to 200%. So 200% and having interest rates going up, it's going to be a tough discussion. But Greece is a small country, so Greece does not have a lot of lever in negotiations. Given what's been going on, the spreads of all the southern countries have been widening. So one way, either the southern countries get together and go have a big debate with the northern countries, and they say we need to figure out something. Now this is an opportunity for Europe to do a fiscal consolidation and for all the fiscal policies to go to Brussels. But I find it very, very hard for this to happen. I'm very skeptic on the euro. I think it was a good idea, but I don't think it will last past 2030. And I'm saying that because it will be 30 years after its launch. And I find it very hard, given the problems that are occurring right now, for this to keep up. At some point, Italy, I presume, or Spain, or a big country will say, listen, guys, this isn't working for us. And Italy is an example, because since the day they came into the euro till today, they've not benefited at all within the eurozone. Greece, for example, had 10 good years and then it crashed, but the Greeks felt 10 years, of euphoria before doing everything, and the economy collapsing. But Italy never had that. So Italy, if you look at it from a pure economic point of view, you'll see that, and I'm talking purely economics now, not sentiment, nothing else. You'll see that the numbers don't show any improvement for going into the euro. So at some point, I guess either the euro will need to change, or someone will get out. Either a strong country like Italy will say, I'm going out, or a very strong country like Germany will say, I don't want to support all these guys, I'm getting out. Now, of course, if Germany were to get out first, the problem would be that its currency would get so strong that then it would have other issues. So we're in a crossroad, and I think that crossroad will show up very soon, and we'll have another crisis, I guess, in Europe. I hope it doesn't become a very big crisis, but I think it's going to be a serious discussion, and the future of the euro will be determined there. I'm not very positive on that. I'm positive on Europe, but I'm not positive on the euro. I think that if European countries were to break the euro and keep all the agreements intact and everyone going to their own currencies, I think things would be better initially there would be a shock, but I think the flexibility that would occur would help the countries. In my opinion.
Just curious, what's the general sentiment in Greece these days?
Well, the general sentiment in Greece is good, because Greece has been in a crisis for 10 years. The world has been doing very well for the last 8 years. QE, economies were growing. Greece just started growing like 2-3 years ago. So for the last 2-3 years, after being 10 years in a crisis, being out of the crisis, and once you got out of the crisis, you had COVID, so everyone got in again. So now it's like everyone's getting out, everyone's trying to to live their life again. Again, there are the issues of the debt and the issues of the interest rates, but the economy has been growing a lot, so the sentiment has been very positive. As long as we grow and as long as there are no issues or external crisis, Greece will do well. But again, the world is bigger than Greece, so you need to have a balanced view on this.
Yeah, speaking of bigger than Greece, obviously, I know you've been highlighting a lot of what's been happening in Japan with the Bank of Japan, obviously trying to defend their yield curve there, basically. Do you have any particular thoughts on that? I mean, obviously, you've got the dollar wrecking ball. There's lots playing out, but Japan seems like everyone's kind of forgotten about them.
Well, Japan is very interesting because everyone has forgotten about them, although the yen has been steadily falling. And it could, the chart-wise, it doesn't look good. Okay, so now fundamentally, when you do yield curve control, the difference between QE and yield curve control is that QE, you do a fixed amount of buying at any price. In yield curve control, you do unlimited amounts of buying at a specific price. So in order for the Bank of Japan to keep the 10-year bond at 0.25, he needs to be buying everything that there is on the offer side. So if the yen is falling, if inflation pressures are rising, then it means that bond yields should rise as well. And then you have pressure because people are selling. So the Bank of Japan needs to buy more. Bank of Japan, if I'm not mistaken, is the balance sheet of the Bank of Japan is 130% or more than GDP. So it means that Bank of Japan has been buying everything. And the question here is, what's the end game? Because the US is at 37%, the ECB is around 80%. So everyone's going to the direction of Bank of Japan. And we've seen some spikes trying to break the 0.25 the last few weeks, although it's like mini bips on this. But you see that there is pressure. So I guess at some point, I don't know how soon that will be, the finance minister of Japan will get to the central banker of Japan and will say, listen, the right pocket owes the left pocket. Let's figure out something. So my guess is, unless there is a war, which I hope there is no war, but let's assume there's no global war, because historically the only way debt has been written off has been a war. There's never been a debt write-down in times of peace. But let's assume that because everyone's in this position, this could happen. So the Bank of Japan will go to the finance minister will go to the Bank of Japan saying, look, we owe each other money. We're the same entity. So I guess they will say, okay, how much do I owe you? I owe you like how many trillion? Let's do a swap and issue a 100-year Japanese bond at 0.25, whatever, and we'll swap it and we'll park the amount in the garage or whatever. So I think that's how this is the best scenario for this to play. But again, when this happens, what happens to the yen? Likely the yen will fall initially, quite a lot. And then people will realize that there's no debt in Bank of Japan, or the debt is, sent to perpetuity. And then they will do more QE, they will send more money, and things will try to evolve. Now, the problem is the following. For the last 10 years, we've had QE globally, but we've not had any inflation. So suddenly now we have inflation. What changed? Two things changed, in my opinion. The first thing that changed was the fiscal policy. Everyone gave fiscal money instead of monetary money, which is different because when you do QE, the central bank buys government bonds, keeps yields low, so everyone can borrow at very low rates. When you do fiscal, I send you a check to your bank account and you can spend it directly. So in terms of inflation pressures, the latter is more important. So it has a direct effect in you spending the money directly. So you get the money instantly. So this is what happened during COVID. We had a lot of fiscal injections. The US gave like 5.2 trillion in fiscal spending. So you don't understand the amounts we're talking about. And then you had the war in Ukraine, which is inflation, which created inflation because of the energy prices. And you also had the supply chain disruptions because of China and COVID. Everyone likes to compare today to the 70s and say what happened in the 70s, Volcker sent their interest rates higher. Is this the same? I don't think it's the same, because in the 70s, there was no debt. There was debt, but you could raise rates. You wouldn't blow up things. The economy was doing well. So you could raise rates. With debt, global debt to GDP over 300%, I don't know for how long you can raise rates. At some point, something will break. And we can see the signs of things breaking. I mean, the Japanese yen is an indicator. The euro going close to parity, it's an indicator. The emerging market currencies the non-commodity ones are collapsing. You see things breaking. You haven't seen it. You've seen the economy slow down because you've seen housing starts going lower, mortgage rates going lower. You're not in a contraction mode yet, but the way things are going, they're forecasting that within the next 6 months we'll be in a contraction mode. Now, contraction mode with inflation and high rates, I can't see how something doesn't break. And at that point, again, the central bankers will have a discussion and will either have to pause, reverse. They'll need to do something because they won't be, you don't want to have inflation and a recession. That's the worst outcome of all. So I think that's where we're moving right now. And I think the most important thing is that macro is very big people tend to focus. Let's say crypto guys tend to focus on crypto. Not technology guys tend to focus on technology. Everyone tends to focus on their micro world. But the thing is here, macro is much bigger. And why people do that? Because for 14 years, 4, interest rates have been very low, close to zero. So when you've been in an economy for 14 years, or a trader for 14 years, and you've been watching a market with zero interest rates, what do you know? You know that environment. You don't remember the previous environment. You don't remember how it worked. You're going to read about it. You're going to figure it out. But unless you've lived through it or you've spent a lot of time analyzing it and going back, you will not understand it. So your DNA and your, let's say, your habits, because your habits is repetition of what you're doing, your instincts are, okay, the Fed will reverse instantly. I think it will reverse, but maybe it won't reverse as instantly as anyone expects. So when you've operated in such a framework for 14 years, low interest rates, you need to start operating in an economy with interest rates. I'll give you an example. All the growth stocks on the Nasdaq. I'm not saying they're bad companies or good companies. It has nothing to do. But valuations went through the roof. Why did they go through the roof? Because when you have a growth stock, which doesn't have any earnings, has only revenues, what do? You go 20 years out. You say what the revenues earnings will be in 20 years out. I'll discount it to today's numbers. Since interest rates are zero, the discount factor is very low. So the present value goes through the roof. And you say, okay, this is valued at XYZ. Now, interest rates go up. So this net present value collapses. So intuitively, you say I'm getting 3% on my bank account with no risk. But the reality is that your discount model is changing and all the net present values are collapsing. And as they collapse, the valuations change. Then you have a liquidity problem. The liquidity problem creates another problem, which is you sell what you can, not what you should. So maybe good stocks fall as well when they shouldn't be falling. And this creates a cascade which has started to unravel, but we haven't seen everything happening yet.
Yeah, I mean, I think you've summarized it really well. I'm kind of curious your thoughts on, Russell Napier talks about this quite a bit, but, you go to this situation where he's calling it, cap day, which is in essence, what you said is you raise rates, as much as you can, you keep going on global debt to GDP north of 300%. So you have these highly levered global economies. And so you keep raising rates and eventually you break something. And maybe inflation, let's just use the US, for example, inflation comes down from 8.5, maybe it only comes down to 5. Are you left with a situation where central banks are forced to implement, maybe even not central banks, but just sovereigns in general are forced to implement basically yield curve control or basically caps on interest rates, despite inflation still being elevated at, let's say, 4.5%, 5.5%.
I agree. And this is why I think today's reality is closer to post-World War II, where when World War II ended, you had a supply shock and a demand shock at the same time. So you had inflation, and then you had the rebuilding, and you had pent-up demand, and you had a similar conditions that you're having now, and you had also a lot of debt because of the war. So what tends to happen in this case is initially you had like inflation of 18% and numbers like that. So we're having right now, I don't know, 7, 8, 9, depends where you're looking at. You could have higher, but if you look at what's been happening, commodities have been falling, with the exception of gold and oil. Everything else, all commodities have been falling. So I think you get that, what you just mentioned, you'll see inflation ease, and I guess it should ease to 4 or 5%, something like that. I can't put the number right now, but definitely it's going to be better because the year-on-year numbers is what you look at. You don't look at the number, the absolute number. If on year one, oil was at 120 and year two is at 110, you actually have deflation on a year-to-year basis. 110 is a lot, but again, from a year-to-year expectation and the way they calculate it, it seems like prices are falling. So you could get that ease, and I agree you could get that ease. And then the central bankers would be, again, pumping in money to drive the economy higher, and then they would be forced again because inflation would pick up again. So I think the period of inflation will last 3-4 years. We're going to learn to live with it, unless we get something worse in geopolitics, and because there's a big risk here of geopolitical tensions spinning out of control. Okay, so I don't know what's going to happen, and I don't know when it's going to happen, if it's going to happen. But Ukraine is one issue. That there is a Taiwan issue in the back of everyone's head. Things could, unravel pretty badly. But let's assume that none of these happen. So if none of this happen, at some point, supply chains will normalize. And I think they will normalize because now they're shifting out of Asia and everyone's going closer to the region. So you're going from a KYC, know your client, to a know your supplier type of model. You will be asking where your supplier is going forward. You will want him to be close to you. You don't want to have that risk. So as the supply chains shift, which takes years, it doesn't take like a month, inflation will be elevated. Once this normalizes, things will be a bit better. And then the good thing about inflation is that you're actually devaluing your debt. There is a positive component in this story.
I mean, isn't that not exactly what central bankers have basically been, fighting for and wishing for the last 10, 12, 14 plus years, right? Of this disinflation, was it Krugman was secular.
Correct. But what do they want? They want inflation coming from the demand side, which means if you have an economy growing a lot, you spend a lot, prices go up, you need to stop the economy from growing. It's a good problem. Now, when you have inflation, mainly due to supply reasons, this is a tax, and it's a tax which means it lowers your propensity to consume. You have less money to consume on other things. So effectively, you're draining your liquidity from the economy. It's not a positive thing. So it depends where
So it actually makes your debt burden more challenging.
Well, okay, the debt burden doesn't make it more challenging, but it makes your economy more challenging. So the U.S. is in a bad position, yes, but it's in a better position than anyone else, because the U.S. What's the key issues? When your debt is linked to your productivity, it means that when your currency devalues, let's take an example, and let's say the dollar falls, which is not falling, but let's assume it fell, then the US economy would be doing well because it would be more competitive and it could export. Now, let's go to Europe. The euro could be falling, but if it was Italy, it could be falling another 20% from what it's falling. So it's relatively strong to where its production in the economy is. So the two are not linked together. And there, you get a benefit from the inflation side of the debt, but you don't get the maximum benefit of it. So, there are good things about inflation, which is the debt thing, but you don't get the 100%, value from that inflation on the debt side. On the economic side, you get the problems that we all know.
Yeah, and then you've got obviously, the Eurozone's energy issues, which again, as you said, if inflation is going to stick around to 3 to 4 years from now, I think that I'm assuming energy is part of your key thesis there as well.
Well, the energy thing is Europe is very dependent on Russia, and they're trying now to fill up the tanks to the inventories, but Russia knows that Europe is trying to fill up the inventories, so it's cutting supply in order not to allow Europe to fill in the tanks and to be able to squeeze them in the winter, or to have the upper hand on any negotiation going forward. So again, this is very tricky. And, Europe has been trying to go on a green transition, but the whole thing had no planning. So they decided Europe's going to transit to green without even getting ready for that. So they shut down all the coal mines, all the electricity, the nuclear ones, which Germany got really scared after Fukushima. And now suddenly you do not have enough wind powers and solar panels to keep an economy. And also, what do you do at 1 o'clock in the morning? There might be some wind, there's no sun for sure. So you need extra sources of energy. So A, Europe was not ready. B, the energy made it even worse. So now everyone's trying to pull the coal plants on. There's a discussion about nuclear again, which hopefully is going to go forward. I don't know. But I wish Europe would understand that nuclear is the only clean energy, which makes sense, in my opinion, at least, and it's sustainable. Until we find batteries, which can keep the energy of the sun and of the wind during the day, and you can store it for the whole night, we're not there yet. I think that the only solution right now is nuclear in terms of clean energy.
Yeah, no, I mean, I definitely agree. I think it's rather ironic that, we try to get rid of fossil fuels and now we've got the coal power plants fired back on. So, and these are the same individuals that are complaining now about the cost of living. So, it's quite the predicament. And I think that, as you pointed out, I think these are going to be very challenging years over the next 3 to 4 years, at least. But how do you, if there's any advice for, the listener, you can't give financial advice, but I mean, how do you position, let's say, yourself, or even like, you're telling your family, like, I mean, again, I think that these are going to be extremely challenging times for a lot of people trying to maintain and preserve and even grow their wealth in this environment. I'm kind of curious to hear your thoughts on.
All depending where you are, it makes a difference where you live. So where your base currency is.
I mean, I suppose. Let's say this is a Canadian show.
I'll answer the questions. It's not. I'm not avoiding the answer, but I'm just saying that you need to have an understanding of where you are to answer that question in the best way. But I'll tell you what I've done. And 3 months ago, I sold everything. I went to cash 100%, if not 195%. And I said, I've seen this movie before. I know something's going to break. I don't know what's going to break. I know volatility is going to be through the roof. So unless you're spending all day long in front of the screen trading, which is fine, you can capture that volatility in your trading. But if you're not a guy or lady, or you're spending no time in front of a screen and you're not a professional, you should. My view is you should reduce your exposures. I think there is more downside to come. And again, be careful, because when there is a market going down, it never goes in a straight line. So, markets could go and you'll see the squeezes that you saw 10 days ago that we're seeing again now. So you see all these things and then you get the squeezes. And I think it's very interesting to know that for example, the traditional portfolio, the 60-40, which is risk parity, is like 18% down this year. I think it's one of the worst years ever. I think it's probably the worst since 1962 or something.
Was that? I think it's like a 15% decline in nominal terms, right? So then you adjust it for inflation, you've lost 20% of your purchasing power.
And Goldman did an analysis which came to my attention, which said that since November 2020, if you calculate all the money that came in, it's around 1.4 trillion until March. Out from the funds that invested, fund inflows, okay? Only 20 billion have gone out. Only 20 billion out of the 1.4 trillion. The average purchase price on the S&P during the last 2 years is approximately around 4,100. So now I think we're at around 3,600, something like that, 3,700. So there hasn't been a lot of wealth destruction. There has been a lot of profit destruction. So, I've been making like a lot of money, but I'm still losing from my profits. And if I'm losing, I'm not losing a lot of money on my capital spend on average. So again, people feel very comfortable yet, and you haven't seen the capitulation. So, you bought at 4,000, it's at 3,700, you're losing like 8%. You say, okay, 8%, it's not that bad. You don't feel bad with 8% when the market has collapsed 20%. You say, I'm doing better. But your purchase, you understand what I'm saying?
Yeah, so I get it.
The sentiment is not very scary yet. So my feeling is, and I'm saying, I'm having cash in an inflationary environment, which is funny, that cash has done better than anything else. If you take out oil, I think the asset class that has done better than everything is cash. You've lost the inflation rate and nothing else. And if you put it in the bank, you've lost even less. But if you've had it in any asset, you've lost money, which is ironic in an inflationary environment. But why is this happening? Because it's a liquidity problem. And why is it a liquidity problem? Because the central bank is raising money. And I think this doesn't stop now. I think something has to break for the central bank to reverse course. I don't know what that's going to be. I definitely don't believe it's banks. I definitely don't believe it's the banking system, because post 2008, everyone's aware of the banks, the mechanism is ready, the central banks know how to deal with it. So the whole plumbing is ready for that. In 2008, there was no plumbing for that. They had to figure it out. They had to save the banks. There was a risk of, the systemic risk. In this case, I don't think that systemic risk exists. But I think that things are going to break, and I think there's going to be a lot of damage in private markets, meaning that private investments, which were valued again with zero interest rates, you'll need to stay in for longer in these investments. So I think that's where the problem is. I believe that one should keep cash, depending on what area they are. Obviously, the local currencies depend where their expenses are. But I do believe that the dollar goes higher. I do believe that given the what's going on, I think the yen goes much lower, and I think that the euro could break parity within the next 18 months. So again, it's not an easy, and there's going to be a big fight at the parity level. But it feels to me that everything is aligned for the dollar to go stronger. And the weaker the world goes, the stronger the dollar goes. Because what do you do when you're scared? You buy US treasuries. What are you going to do? What's the safest asset right now? Okay, you might be buying gold. Okay, fine. But you can't buy everything in gold. And again, if you have a liquidity event, I'm afraid that gold will be sold off as well. It won't go to 1,200, but from 1850 to 1,700, it could go. It's not out of the question. So I think keep cash, be on the sidelines, wait. And when you see that Wall Street Journal headline or Financial Times cover page saying that the world is ending or something huge that you didn't expect is collapsing, then you start buying, in my opinion. But we're not there yet. That's how I view it, because either you have to be on the screen, trade, which you can make a lot of money because there's a lot of volatility. So if you're on top of your game, you could be making money. But if you're not a person who does this for a living, I think holding cash gives you tremendous ammunition to do well in the next phase, which will come in the next 3 to 6 months.
Yeah, no, very well.
Maybe the market breaks sooner, because you never know. It could be. I think the market goes another 20% lower. It could go in a day because something breaks, or it could take 4 months for it to go there. You understand? So again, I think there is more downside. That's my understanding, at least.
And so, kind of last question to wrap it up. How are you looking at the crypto space as well? I know that you're getting involved in that space. I know you've been looking at it for quite some time. So, kind of curious to get your thoughts on that. Obviously, there's a ton of carnage in that space. I think probably a good natural cleansing too, though. I think it was much needed. Like, obviously, I've been long that space for a number of years now, but just seeing some of these big players that's like, the tide, when the liquidity crunch comes, the tide goes out, you kind of see who's swimming naked. And I think we're seeing a lot of these, scam coins or shady, crypto banks and all this stuff that are now, coming under pressure. So I'm kind of curious to hear your thoughts, maybe the longer term outlook as well.
Well, first of all, in the short term, macro is much bigger than crypto, much bigger. So again, the liquidity crisis or the liquidity drainage we're witnessing affects all assets that don't produce. It affects more the assets that don't produce any revenue or any earnings. So you're just holding an asset. There's a liquidity drainage. You're going to sell those assets first. Now, so I think the carnage we're witnessing in crypto, it didn't start from a crypto specific reason. It started because there was a macro event, which was interest rates going higher. Now, when that, as you said, when the tide goes out, you see who's left swimming naked. So as the market fell, a lot of things started to blow up. Margin calls started to hit. Things started to collapse. So I guess, I don't know, there were like 10,000 coins, 10,000 cryptos. I guess, 9,900 are going to get wiped out. But if you see the amount of talent and the amount of people that go into the space and the amount of let's say energy that's going in there, for me it's very hard for this ecosystem to reverse. I think this ecosystem is here to stay. It will evolve. Again, if there'll be crisis, things will blow up. There will be Ponzi's, like in any market. There'll be bad actors. There'll be good actors, like everything. But I think it's here to stay. And again, like in the 2001 bubble, in the tech bubble, there was pet.com and there was Amazon. Pet.com went wiped out. Amazon fell 85% or something like that. And now it is 2000x higher. So it depends where you invest. So now if you believe in the ecosystem, which I do, I think we're here to stay, and I think there will be opportunities to buy. Again, I don't think we've seen all the blowups yet. We'll see more. There'll be more stuff, and people will get very scared, and there's going to be a lot of writing about this thing dying and not being a value. There won't be any value for it. But I don't agree with it. I think only the intellectual capacity that has gone into that system, there is a value to that. And the way I like to look at it is what the internet and voice over IP did to telecommunications. I studied in the States in '95. To call my mother in Greece, I paid like, I don't know, $10 a minute with MCI and AT&T. Ridiculous. Now you can speak FaceTime, not on a phone, for like 2 hours for $20 a month because that's what you pay for your internet. So what the internet and voice over IP did for telecoms, crypto will do for financial transactions. So I don't think banking system will collapse. I don't think DeFi will overtake CeFi, but I think these two will merge at some point or will work together. And I think everything will become more efficient. And I think we will see a new world, which will be much better. But again, there'll be a transition period where you've got to pick the winners. And I think the next 10 years are super exciting in that space. But again, in the short term, macro is bigger than crypto. You could now, if you're willing to keep your coins or you're willing to be buying more and more and more, I think if you buy the good names, I mean the good projects, I think you'll be okay. But you need to be very careful, and you need to see. You need to do a bigger analysis than what you were doing like a year ago. You were buying anything and you would be making money. That's no longer the case. Like in NASDAQ in '99, whatever you bought, you were making money until you were not making money. So I think it's a pretty similar situation. And the reason is because human behavior is always the same. So humans are trading this. Humans want to make money. It's the same psychology.
Yeah, no, absolutely. I tend to agree. You gotta, macro obviously trumps all, but if you have a long enough time horizon, that I think that space it's as you alluded to, it's the human capital that's going into that space that is going to be hard to trump. So, but I think that's a great place to wrap it up, Michael. Basically, the gist here is have some cash ready for the opportunities that are coming because they are coming, and macro trumps all. So really appreciate.
I have one more thing to say. What is the hardest trading position? What is the hardest trading position you can have? Cash, do nothing. It's the hardest thing not to do anything. And I've been fighting with myself because being in markets like for 20 years, you understand that I see things. The hardest thing for me is to do nothing.
Yeah, hard to sit on your hands.
Yeah, it's very hard. Because you will see something minus a lot or plus a lot, and you will want to do something about it. And you shouldn't, unless you're trading it, instantly. But again, if you're an investor, I think the hardest thing to do is do nothing and be patient. You'll understand where you should be buying. We're not there yet. It doesn't feel to me that we're there yet.
I feel like that's almost like a life lesson, though. It's like not only investing, but just in general life, that people are not patient. And
I'm the worst person for that. I'm the most impatient person you've ever met, and this exercise for me is life-changing. I can tell you that. I'm one of the most impatient people you've ever met, and for 3 months I've been sitting on my hands and doing nothing. It's a very hard exercise.
Going stir crazy, texting Keith all day. I love it. I love it. Well, yeah, thanks again, Michael, for obviously taking the time here. I think you brought, a tremendous amount of value. Definitely summarize a lot of my sort of thoughts going through my head. And yeah, I think we see the world in a similar fashion. So, thanks again for having you on the show, and look forward to having you on again at some point down the road.
For sure. I'd love it. And thank you for having me, and say hi to Keith for me.
Thanks, Michael.
I try to keep up with his level, so it's very hard, but I'm doing my best.
Everyone's favorite boomer there. I love it.